Hey everyone, and welcome back to the channel. If you're serious about leveling up your investment game, you've come to the right place. Today, we are diving deep into an absolute classic, Common Stocks and Uncommon Profits by the legendary Philip A. Fisher. This book is a game changer, trust me. Before we jump in, do me a quick favor, hit that like button, share this video with a friend who needs it, and make sure you're subscribed so you don't miss any of our future deep dives. Ready? Let's get into it. So, who was Philip A. Fisher? Imagine a guy so influential that Warren Buffett himself said he was 85% Graham and 15% Fisher. That 15% is what we're talking about today. While many investors were focused purely on numbers and balance sheets, Fisher pioneered a different approach. He was all about growth investing. He believed that the biggest profits came from finding truly exceptional companies and holding on to them for the long haul. Fisher's philosophy wasn't about timing the market or jumping on hot trends. It was about deep investigative work, what he famously called the Scuttlebutt method. Think of it like being a detective for stocks. He wouldn't just read annual reports. He'd talk to everyone connected to a company. He'd interview competitors, suppliers, customers, former employees, and even scientists in the industry. His goal was to get the real, unvarnished story that you could never find in a company's official filings. He wanted to understand the company's competitive advantages, its management quality, and its long-term growth potential from the inside out. This scuttlebutt method gave him an informational edge that was almost unfair. It's about gathering qualitative data, the stuff that doesn't show up on a spreadsheet but ultimately drives a company's success or failure. It's the human element of investing. Now, to make this scuttlebutt method effective, Fisher developed a framework, his famous 15 points to look for in a common stock. This is the core of the book, a checklist for identifying those rare, exceptional companies worth your investment. We are not going to go through all 15 in exhaustive detail. You should definitely read the book for that, but we'll cover the big, overarching themes. He grouped these points into a few key areas. The first is about the company's fundamental business. Fisher asked, does the company have products or services with sufficient market potential to make possible a sizable increase in sales for at least several years? He wasn't interested in one-hit wonders. He wanted businesses that could grow consistently, year after year. Think about companies that are constantly innovating and expanding their market, not just defending their current turf. Another critical point was about management. Does the management have a determination to continue to develop products or processes that will still further increase total sales potentials when the growth potentials of currently attractive product lines have been largely exploited? In other words, is the leadership forward-thinking? Are they reinvesting in the future? A great company doesn't rest on its laurels. It's always looking for the next big thing. Fisher was also obsessed with a company's competitive moat. He looked for businesses that had something unique that protected them from competition. This could be a technological edge, a strong brand, or a cost advantage. He wanted to know, does the company have a worthwhile profit margin? And what is the company doing to maintain or improve profit margins? High and sustainable profits are a sign of a strong, defensible business. One of his most important points, and one that Buffett often talks about, is the integrity and ability of the management team. Fisher believed you should only invest in companies run by people you can trust. Are they transparent with shareholders? Do they have a long-term vision, or are they just focused on the next quarter's earnings? For Fisher, betting on a company was betting on its leadership. A brilliant business idea can be ruined by poor management. Fisher also had some strong opinions on when to buy and, just as importantly, when to sell. This is where his philosophy gets really interesting and goes against the grain of what many people think for buying. He wasn't necessarily trying to buy at the absolute bottom. He believed that if you found a truly outstanding company, it is better to pay a fair price for it than to buy a mediocre company at a bargain price. The growth potential of a great business will more than make up for not getting the cheapest entry point. His advice on when to sell is even more radical. He basically said, if you've done your homework correctly and found a truly great company, the best time to sell is almost never. Think about that. The conventional wisdom is buy low, sell high. but Fisher argued that if the company continues to meet his 15-point criteria, why would you sell? You'd be giving up on future decades of compounding growth. He identified only 3 reasons to ever sell a great stock. First, you made a mistake in your initial analysis. The company wasn't as great as you thought. It happens. You admit the mistake, sell, and move on. Second, the company has fundamentally changed and no longer meets the 15-point criteria. Maybe management has changed for the worse, or their competitive edge has eroded. Third, you found an even more promising investment opportunity and need to free up capital. But he stressed that this should be a very rare occurrence. He warned against selling for what he called the wrong reasons. Don't sell just because a stock has gone up a lot. Don't sell because you think a market downturn is coming. Don't sell just to lock in a profit. He told a story about a stock he sold way too early, only to watch it grow another 20-fold. That lesson stuck with him. The real money, the uncommon profits, comes from holding on to the winners for years, even decades. So, how can we apply these lessons today? Let's break down some practical action steps. First, adopt the scuttlebutt mindset. Now, you and I might not be able to call up the CEO of Apple, but we can do our own version of scuttlebutt, read industry trade journals, go to online forums like Reddit where customers and employees talk about products. If it's a retail company, go visit their stores. If it's a software company, try their demo. Talk to people who use the product. You'd be amazed at the insights you can gather just by looking beyond the financial statements. Second, use Fisher's 15 points as your own checklist. Before you invest in any company, run it through his criteria. Does it have long-term growth potential? Is the management team top-notch and trustworthy? Does it have a sustainable competitive advantage? Is it reinvesting profits wisely back into the business? This framework will force you to think like a business owner, not a stock gambler. It helps you separate the truly great companies from the merely good ones. Third, change your perspective on selling. This is probably the hardest one. We're all tempted to cash in our chips when a stock has a nice run, but ask yourself, has the fundamental story of the company changed? Is it still a great business with a bright future? If the answer is yes, then have the conviction to hold on. Let your winners run. Compounding is the most powerful force in investing, but it only works if you give it time. Fourth, focus on concentration, not just diversification. Fisher was a believer in holding a relatively small number of outstanding companies that you know inside and out. He famously said that investors have been so oversold on the benefits of diversification that they have lost sight of the real goal, which is to make money. Owning 50 different stocks means you probably don't know much about any of them. It's better to own a handful of businesses you understand deeply. To summarize the key takeaways. First, invest for the long term in growth companies. Don't chase short-term fads. Second, do your homework, become a business detective and use the scuttlebutt method to gain a real understanding of a company. Third, management matters a lot. Invest in people you trust. And finally, if you find a winner, hold on tight. The biggest profits come from patience and conviction. Fisher's wisdom is timeless because it's not about market timing or complex formulas. It's about a fundamental, common sense approach to identifying and owning wonderful businesses. It's a philosophy that empowers you to think for yourself and make intelligent, informed decisions. And that's a wrap on common stocks and uncommon profits. What an incredible book. It truly shifts your mindset from being a stock picker to a business analyst. I hope this summary has given you a solid overview and inspired you to pick up the book yourself. Let me know in the comments what your biggest takeaway was, or if you've ever used the scuttlebutt method in your own research. Thank you so much for watching. I'm already excited for our next video, where we'll be tackling another giant of investment literature. You won't want to miss it. If you got any value from this at all, please hit that like button. Share it with someone who might benefit, and most importantly, subscribe to the channel and turn on notifications so we can continue this journey together. Thanks again, and I'll see you in the next one.